KLZ 560. David Stryzewski joining us now, Sound Planning Group. David, welcome. How are you?
Hey, doing fantastic, John. How about yourself?
Good. Always a joy to have you. Talk to us about the crypto summit that just went on at the White House not long ago.
Oh, my goodness. I mean, so this is unprecedented, a historical event. The White House is now talking about blockchain, crypto, and of course, the future here. So, not only is the administration, definitely giving us a green light that they are definitely looking at these as real assets and something that should, have value here in the future. But they're also going to be holding these things and holding them on our balance sheet. The big question that everyone has coming out of it, though, is, well, it says that they have to be a net neutral in order to purchase these things. And there's a lot of ways that you can be net neutral. I mean, technically, look at everything that Doge has just been saving us. That could be technically rolled over to, purchase different assets if different things are going on. So I think that we're early. This tells us that we're early. We didn't see a big pump following it. So I just want to encourage people. It's a volatile place out there in crypto, but this is just still early. No, you don't have a crystal ball, although you watch the crypto side of it way closer than I do. Where do you see it headed? Well, it's definitely headed up. I think that in the near term, we're seeing a lot of volatility just in the market. The Fed has given us a narrative of what to be expecting inside of the market, and they ultimately control, the fear and greed indicator.
Right.
And so, as we're looking at what's going on with the Fed, we got, big meeting coming up here this week. I don't think that they're going to reduce rates. I think they're going to keep them. It's almost 100% certain, and that's already baked into the cake. Everyone expects it. Now, what's interesting though is that I think that we're getting a lot closer to a recession, and I think President Trump is actually okay with that from this standpoint. Very small percentage of Americans have a whole bunch of money in the stock market.
Right.
Now, but there's still a ton of people who do. But hey, if the vast majority have a lot less, his goal is less concerned about the stock market, more I think about the job market.
Well, I think let me add one other layer to that. I think you're correct, by the way, but I think the other thing that he's looking at is he, some way, somehow, has to get the Fed involved. You and I have talked about this many times. The Fed, in this case, I still believe is late to the game, just like they were in raising rates. And I think Trump knows that the only way you're going to get the Fed involved is if there is some sort of even a flash recession. Maybe that's not the right word, David, but you got to give them a reason to move things down, or you're not going to get housing mainly back on track. And I've had this argument with people in the past, and I've even had folks, David, send me charts on, where interest rates were historically as far as 30-year mortgages and all that go. And while all of those charts are great and they're accurate, they don't put into the chart people's sentiment towards the rates themselves. And what I mean by that is when you're used to having a 3.25%, 3.5%, or even 4% rate, and you don't have to do anything, you're not until that rate gets halfway close to that again, and Donald Trump knows that.
Mm-hmm. Absolutely. Yeah, actually, we've talked about this before, but, the mortgage part of this is really the piece that's at risk here for the average American. And this is why I think Trump is okay with letting some things crash a little bit, because that data dependency from the Fed will demand that hey, look, the rates are coming down on the long end because we are slowing a little bit for sure. Certainly GDP took a dive here over the last, 5 weeks. Right. Better than 4 or 5 points now. I mean, that's Richter scale level movement. And, so hey, things are going to keep turning here as the world goes. But if we look at this, strongly overvalued on the Buffett indicator, strongly overvalued on the PE ratios and multiples going forward. We're just at a very expensive time right now, and we're very concentrated in just a few specific stocks. And so I'm concerned a little bit about a recession, but Trump's going to reduce rates.
I'm with you on that one, although I wouldn't be surprised if we didn't see one. But with all that still being said, and a little inside knowledge, when it comes to, large home builders and developers and so on, David, they are not pulling back from investing in future projects, future property, and so on. I mean, the reality is they still see the need for more homes because the inventory levels still aren't where they need to be. These guys aren't concerned right now with where mortgage rates are, or even frankly what the economy is doing, because in some cases they know this play is 3 to 5 years out, and these big home builders know at the end of the day they've got to have land to build homes to keep things rolling, and if they don't, they're not going to be in business.
Absolutely. Yeah, and frankly, they buy a lot of land during recessions.
That's right.
And let's just be clear about something. Recessions are normal, and they're actually healthy. You know, just like your body getting sick every so often is a good thing. Your immune system resets. You go, okay, cool. And now we're off to the races here again. And so the economy is no different. We are going to see a reset at some point, and I think that it's actually going to have a lot of issues in banks, and so I think that there's a lot of geopolitical tensions all over the world that are kind of taking place right now, and we got kind of a financial World War III going, as opposed to maybe the bombs and such right now. Praise God, but. There's a lot of crazy things that could happen in a rep. So I just want to tell people, buckle up, because it's going to be volatile. Even the crypto market's going to be volatile. About the only places that are really steady are super short-term treasuries, growth-oriented index-linking accounts. I mean, you're going to be able to make money in blockchain, et cetera. But I'm a dip buyer. But if I could be honest, I'm waking up right now this morning looking at this week and the Fed not doing everything and some of the tensions that could happen, more risks ahead. I'm thinking, shoot, maybe I may sell the news right now, sell the rip because it's been up, and then buy the dip with some dry powder here when things are on sale. So that would also include real estate as well. So anyway, there's a lot of ways to play this, and we just have to keep our eyes open right now. It's changing quickly.
Tariffs, and I know that has an effect on things as well, something I believe the Fed is also looking at, and I am not one, and I argue with folks on this from time to time. I'm not as concerned about tariffs as I think a lot of people get concerned. Globalists hate tariffs, by the way, because it kills things on a global basis, and yet here at home it levels the playing field in a lot of ways, and I don't want to get into all the details of that, but one example, and I watched a great video that was put out the other night on, for example, cattle, beef, and sheep. And the reality is we have a country right now, because we've not done tariffs on sheep especially, the reality is we're importing a ton from New Zealand and Australia with zero tariffs. And in turn, David, we have very little sheep production in this country.
Yeah, absolutely. So, we've allowed imbalances to occur for whatever reason. And actually, if you look at Donald Trump's record, prior to ever even announcing a presidency, he was talking about how we've been ripped off on trade deals. So it's just, it's a leveling of the playing field. I think he's using it because we're in a position of strength for sure. And, it's bringing a lot of people back to the table here. But, he's only got 4 years. So this guy's not going to be there 8 years from now. He's not running a re-election again. He's going to want to be remembered for giving America a reset. And it's not the reset that we were talking about, previously with the Great Reset, Klaus Schwab, but in this case, it'd be a reset of various economic factors, resetting, our relationships in trade, and also bringing a whole lot of jobs back here in manufacturing to the United States. So I think a lot of pro-growth policy is going on. Certainly, there's going to be a lot of volatility here, but I think that we've got kind of actually a little bit of a long haul. Next 2 years there's going to be a lot of surprises, a lot of things that are changing, and I think that a lot of the headline data that many economists follow probably not going to be as beneficial in following, just because the indicators are so dense in actually sharing what's going on in the economy. So we're going to have to find some new ways of evaluating the up and the down and where we're going, but I think we have to have more of a generational perspective as opposed to how did it do this quarter perspective. If you're worried about it this quarter, then you probably have way too much risk, and you need to be looking at something. But have a generational perspective, and you're going to be in great shape. And candidly, the blockchain stuff, again, it's early. And
I'm going to go back to something you just said. Either you've got way too much risk out there, or in some cases you've got far too much debt. And maybe what you ought to be looking at, and I want to make sure I'm very very clear in how I say this, because there's a lot of folks out there right now, David, that are sitting on a 3.5, maybe even 4% mortgage, but because of whatever reasons, things have cropped up. They've had other emergencies. They've had to put things on credit cards. They could be paying upwards of high 20s, low 30s on interest rates on credit cards. And I hate to say this, but they're holding on to a 3% mortgage while paying out 30% on the other end. At the end of the day, they could even in today's rates refi and lower their overall cash position and be a lot healthier at the end of the month. But because they're so tied to that 3% mortgage, they won't do anything about it.
And
by the way, that's ignorance, by the way, when it's all said and done.
Yeah, I mean, there's a lot of factors that go into it. You know, there's a home equity line of credit, too. That would be an okay option.
That's another one to look at. Absolutely. I mean, again, people, my point is, you get so tied in. It's like, I come out of the car world, David, as you know, and so many people go out and buy cars based on payment rather than what's the actual cost of the car. I think the same thing can happen at times with mortgage rates. It's like, whoa, I'm in this for 3.5%. Why would I ever change that? Well, if you've got 4 credit cards that maybe, and I'm not exaggerating because there's people out there this way that, you got $100K in credit card debt that you're paying 28% on. I can tell you right now what I would do.
Yeah, you'd go refi that.
I'd go refi that. Even if it's at 6%, I'd go refi that because at the end of the day, I'm ahead.
100%. Yeah, absolutely. That's a great idea. That's good advice. That's a fiduciary thought. And I think people have way more debt. In fact, a lot of people have been putting their equity or their credit card money in crypto or in the stock market or something. And so get out of the risk stuff right now.
Yep.
This is what's happening with the big shaky markets, is that it gets rid of what they call the weak hands. Anything with leverage that can't be there longer term, it's going to get too squeamish, that's out.
Yep.
And so I think there's going to be some phenomenal buying opportunities here as the months roll along. But, you got to just be aware of what's going on and understanding that it's okay to get sick sometimes. You just want to get healthy as fast as possible.
That's right. Absolutely. David, as always, appreciate you. How do folks find you?
Hey, myspg.com is our firm. Actually, pretty awesome. I was looking today. We have 178 5-star Google reviews.
Nice.
And it's pretty cool. If you even look on there, I mean, I teach all the classes, do all the stuff, but my name is hardly even mentioned. And most of these people have been with us for 5 or 10 years. So it's an awesome thing, helping a lot of families here on college campuses to understand and better navigate their retirement needs. So we've got a lot of great resources on that website.
Awesome. David, as always, I appreciate you. Have a great evening.
Hey, appreciate you, John.
All right, man. You bet. Take care. Appreciate him very much, by the way. He's just a great guy and loves our program. And if you've got any questions at all, please give him a call. He's always there to help. He's got some great resources for everybody listening, by the way.